PMI season, it's that time of the month where purchasing managers' indexes are released worldwide. We've had China coming in at 50.9, was supposed to be 51.2. The United States came in yesterday with its manufacturing data at 51.3, and it was supposed to be above 54, so a mixed picture. What about South Africa? Well, South Africa, having gone above 50 last month, has come in below 50 this month. It's a volatile figure, but it means that the South African economy, manufacturing economy, is contracting. It came in at 49.3. In the studio with me in Cape Town is Abdul Davids, the head of research at Kagiso Asset Management. Disappointing figure again, Abdul.
Definitely, thank you, Lindsay. And after last month's upbeat numbers, I think across the board we've seen some of the major indices, sub-indices also declining quite sharply as well.
What was the main reason for this? I mean, if I read your press release, which you kindly sent us earlier on, it says the pullback was largely driven by significant declines in new sales orders, minus 8.2 points. That's right. A really, really big move. Yes. And also business activity. Now let's contextualize new sales orders. That means that people are saying, I don't think that I'm going to have any sales in the future, so I'm going to cut back on my new sales orders. Is it as simple as that?
Not exactly, because the absolute level is still at 52, above 50. So it still points to quite a robust sort of new sales number as well. What we have seen is lumpy sort of new sales orders coming through. Bearing in mind we came out of a very weak fourth quarter last year. So what we surmised last month that happened was that some of the slack that we saw in the fourth quarter of last year coming through in new demand in January and February period, especially the February month as well. Now that is a volatile number, as you've mentioned, but particularly new sales orders, because it's very much contingent on what's happening on the factory floor as well. And unfortunately, that level of robust sort of activity couldn't be sustained in March. But the absolute level at 52 is still fairly healthy, I think.
It's not bad at all. And what about the other one that you really highlight, and that's business activity, which is 4.5 points down. What's the significance of that?
I think it's more symptomatic of what we're actually seeing, and that actual activity levels have been declining and continues to decline as well. And that is probably the more worrying aspect, and that in conjunction with the sort of the prospects in terms of forward-looking, the leading indicator, for example, the prospects of the manufacturing sector, and which is very much driven by sentiment as well. And unfortunately, what we have seen is that a lot of it is driven by the political scenario in the country, but more particularly the currency as well. And to see that weakening in the face of quite a weak currency as well, I think is probably quite disturbing as well.
Yeah, it is. I mean, it seems to me as well that we've got this situation where in the past the PMI has been driven by international sentiment. We've very much been driven by what's happening overseas with the US or the Chinese or the European PMI. Now we've got domestic issues which are really exerting their influence, i.e. what you've just mentioned, what's happening on the factory floor, the currency, and also politics.
That's unfortunately right. We have seen the weak global backdrop. A lot of the Eurozone PMI is still very much stuck below 50 and contracting further this month as well. So against that weak backdrop, we needed a strong sort of domestic economy to pull us through. And unfortunately, all the indicators are that the domestic side of things are actually weakening as well. The backdrop, as you know, with the labor issues around the mining sector, spilling over into some of the industrial companies as well. We are going into labor negotiation season as well, sort of the March to July period. It's typically quite a protracted
Seems to extend itself every year. It used to be just June and July, and now it's almost like a 6-month thing.
Yes, because anecdotally, I mean, the companies that we speak to, what they normally do is in the March-April period, they sort of table the indicative offers to the labor unions. And unfortunately, across the board, a lot of those numbers are coming in at or slightly below inflation. And the unions have outright rejected some of those numbers as well. So I think we're in for a very difficult labour negotiation season coming up, and I think that is spilling into the sentiment for the manufacturing sector. And as a result, we've seen business confidence coming down as well in the sector as well.
So you say anecdotally you've spoken to companies about the oncoming so-called wage negotiation season. Right. Are they pessimistic about it?
Well, what they say is that they sort of have numbers in their minds which they table, and so normally the process is the HR director will sort of engage with the union and say this is what we're likely to settle on or offer to the unions, and they normally have sort of initial discussions. And unfortunately, some of the companies that we've spoken to, a lot of that feedback has been very negatively received by the unions. So that normally means that there's quite a wide gulf between what the unions are expecting and what management is willing to offer. And as a result, that normally indicates to quite a lengthy sort of negotiation process.
Maybe
as well.
we should have a productivity season where the companies sit down and say, how's your productivity been over the last 6 months? And then we can negotiate and start with the other thing. Anyway, that's a slightly cynical view. What about input costs? You talk about the rand. The rand, a massive influence on the inflation equation in South Africa. How's the cost side of the PMI come in?
Well, that's been the negative side of things. So we've seen the price index obviously increasing and being at quite elevated levels, above 80 level. What that means is that roughly about 2/3 of inputs for the manufacturing sector has direct sort of dollar sort of implications as well. So where the rand has weakened by about 10% year to date, what we normally look at is the average rand to dollar. And from last year's average, about 7.50 odd, it's weakened by 15%. So the average is sitting at about 8.50, but the current spot rand is sitting at well over 9. So it means that the trend is weakening, so we'll probably see that price index staying at elevated levels as well into the foreseeable future.
Employment, when I watched the United States data coming out yesterday afternoon South African time, the initial figure was down from 54 to 51.3, but then everybody said, but look at the employment side of things. I mean, is there any hope in South Africa that perhaps the PMI, although below 50, at least we're creating some jobs or not?
Unfortunately, the read-through is not that positive. What we have seen is that the employment index has declined further. So it's firmly stuck below 50 as well. And unfortunately, mining services, for example, which is quite a big sort of employment area, is very much linked to the mining sector. And we know with the backdrop of Amplas, for example, looking at retrenching 14,000 workers, it does not bode well for the rest of the manufacturing sector that is affected by the mining industry, unfortunately.
Okay, very finally, as I always ask you at the end of these conversations, what about the future? You have been fairly cautious about your predictions in the past. Are you still cautious?
I think so. What we have seen is that I'll probably describe February as an anomaly. It's probably an outlier in terms of the actual numbers. If you take into account the February number, we've actually averaged now about 51, or just under 51 for the first 3 months of this year, which is slightly higher than the fourth quarter of last year. But the trend for the last successive quarters has been negative. That coupled with the leading indicator going below 1 again, and coupled with the pressure of sentiment indicators that we normally look at, points to probably further weakness in terms of PMI for the next couple of months. Unfortunately, the backdrop is quite negative. The Eurozone PMIs have declined this month, and I think sort of the only possible sort of positive that we see is probably from the US, but bearing in mind our US exports is quite tiny in the overall scheme of things. So unfortunately, I'm the bearer of bad news.